Good morning. Welcome to Bazaar Morning Call. I'm Lata, and with me are Anuj and Surabhi. Well, there's no running away that the growth scare appears to have gotten scarier. Of course, we have already reacted to the Apple numbers yesterday. We reacted to the Dow futures being 300 down, but the reality is that it is 660 down. And it's not just Apple saying that China is growing slowly and that's why we are cutting our guidance. It's also other details that came from the United States yesterday, the ISM manufacturing numbers, something like their PMI, and that was at a 2-year low. Not just that, new orders have declined rather steeply. I mean, they're down from 51 to 62. Now, that's a fairly big fall when you look at the new orders, which means incremental orders. It's the largest fall in 5 years. So there is a distinct slowdown in the United States as well. So if Apple pointed to Chinese slowdown, the ISM numbers pointing out to the US slowdown itself. So all told, the markets have to adjust equity and debt. Debt is already adjusted. 10-year paper is at 2.5. Remember, we were looking at 3.25. So that has already adjusted, and now equities have to adjust. This morning, Nikkei is at 3% lower. Perhaps the only solace we have is we perhaps partially reacted to it yesterday.
Absolutely. Good morning, Lata. That was exactly the thought that was on my mind. Absolutely no taking away from the slowdown fears that you're talking about, whether it's those Apple sales in China or car sales for us here in India. The numbers have been really, really sobering. And on top of that, the FII is selling. I mean, so far 2019, if you were hoping for some, miraculous reversal, at least right now it's not on, because we had about 1,000 crores of selling in the cash market again yesterday, followed up by the 600 crores of selling that we saw on the previous session. So that's something to keep in mind. But Anuj, morning, my question is exactly what Lata just said. Have we already preempted a lot of this fall? Because we also seem to be coming down to supports. There's a 50 DMA that's coming in. There is a 26th of December low that you keep talking about. I think 10,534 is the intraday low level that we're coming to. So do these numbers and do these levels, sort of have any sanctity at this point?
Yeah, morning, Surabhi. They do, in fact, I normally wear this combination when I have a premonition of a big rally.
Oh, really?
I think the market is due for a 100-point rally today. Let's have a intraday nifty.
Bet. Let's have a bet.
Nifty intraday 100-point rally. Look, I am a risk-reward person. The risk-reward, I've been making this point ad nauseum since Monday afternoon that risk-reward had turned in favor of a short trade, and it does not favor a short trade now. That trade has well and truly played out. The market has rewarded those who followed that risk reward and didn't really believe that that Monday move was a breakout, and because that didn't look like was the case. So just like it didn't favor a long at 10,950, it doesn't favor a short at 10,550. Now, obviously, there's some distance to go to 550.
100 odd points.
100 odd points. But do you really want to take that? Because, intraday, just like you saw on Boxing Day, December 26th, right? Remember the way the market rallied 200 points intraday. And the market is now net short. And there's no incremental negative news this morning. Everything that the US market reacted to has already been reacted to by global market. And this morning, I think there's signs of some bit of buying in Asian markets. So December 26th low of 10,535 is now sacrosanct. Just like the market trapped the week longs over Tuesday and Wednesday, my sense is that perhaps it might now be turned to trap some weak shorts who perhaps came in late yesterday. And of course, the Nifty Bank is also very close to its 20-day moving average support of 26,850. Short point, I think the risk reward doesn't favor a short trade today.
So, Anuj, just to follow up here, now, if we are looking at a bounce back rally, then is it best to play that on the Nifty or maybe the Nifty Bank, or should you be in stocks now? Because mid-caps have been a little funny. Even yesterday, some of the mid-cap IT names are down, some of the NBFCs were still down.
I'll make a point here. My base case remains that the worst for mid-caps is over. And I think we are going to go through a phase where the emerging markets will outperform developed markets. 2018 was about higher cost of capital, which led to the mid-caps falling, NBFCs falling, and mean reversion. Mean reversion is well and truly over. And I think there's a good chance that the cost of capital has also peaked. And, this morning I was reading a very beautiful note from Chris Wood that, the US Fed, perhaps the rate hike is done. Perhaps there's just one more in the cycle. And going forward, the cost of capital rally might return in the mid-cap, beaten down mid-cap black and blue. My sense is, this is going to be a year in which, of course, initially there will be some disturbance, but you'll make a lot of money in mid-caps in the year.
No, that would be the longer call, that there will be fiscal stimulus in China as well, and therefore, the dice will turn. But one will have to see the more near term. At what point? The market as yet has not factored in that the Fed will not hike at all. Yesterday, one of the Fed members, Robert Kaplan, has said that the Fed should not hike for the foreseeable future till all the uncertainties are out of the way. And he himself says that could take several months. That's his quote. But he's not a voting member. Now, we don't know if that would be the way the consensus will turn out. And I'm not even sure whether we have factored in that entire global weakness. India tends to think about itself as a more domestically oriented economy. But we don't realize how globally dependent we are. About 60-70% of the Nifty earnings are globally dependent. I mean, all the tech stocks are. Reliance and all the metal stocks are because they depend on the landed price. Yesterday, which was the only auto stock in the green, Bajaj Auto, that's seriously dependent on exports.
Yes.
So a global slowdown is something we have to take cognizance of. It's quite possible that when there is a congregation of bad news, that's the day the market chooses to turn around. So it could well be possible that today, the market shakes off because it has already reacted. But it also has to contend with fresh bad news. I mean, there's non-farm payroll numbers that will come
out this evening.
We cannot be very sure a person who's taking the risk of buying at 10,500 is also taking a risk. Probably his risk is less, but even that is a risk because we're getting new data on global stocks.
Well, hearing both of you, I think it's going to be an interesting fight between the bulls and the bears. That much is for sure today.
I tell you something, no risk, no reward. In equity markets, at some point you have to take a risk.
Yes, absolutely. So it's safer to take it.
Exactly. It's safer to buy today than it was on Monday. That's the limited point I'm making. For sure, you buy today, you get stopped out at 10,550. You tell yourself, okay, that trade didn't work. It happens, but purely by risk reward, like on Monday there was no ostensible negative, right? And it looked like the market is breaking out, but the triggers came later. So if you follow basic risk reward, the triggers will come later. Market sometimes has a habit of pricing that in already, and most times. Actually.
Well, bulls seem to be active.
No, there is just a bigger growth. A redefinition of growth. The numbers are looking different now. So we will have to see at what point we find equilibrium. And we'll have to decide. I mean, the market will find its level. The market will tell us at what point it sees equilibrium. So more equity advice coming?
Okay, so let's get started. Here are the calls from the wise experts this Friday morning. Mahesh Nadurkar of CLSA says their earnings deep dive suggests that double-digit growth is highly likely this year. However, he says much of this is already priced in. He adds India's late 2018 rally made it among the best performing markets in the world, and it trades at above average valuations versus emerging market peers. He builds in market multiples to mean revert, implying a flattish December 2019 Nifty target of just 11,000. Well.
Okay. So we could still take 11,000 with both hands. On to a global view from CLSA now. Chris Wood says greed and fear's view remains for only one more Fed rate hike, and even that is far from certain, given that rising credit spreads, if not correcting FANG stocks, are increasingly likely to get the attention of the Fed, regardless of Powell's comments at his December press conference about the balance sheet contraction being on autopilot. Meanwhile, he says it is no surprise that monetary tightening expectations in the money markets have reduced considerably over the past quarter in response to the increasingly negative stock market action. He says the implied rate of the December 2019 Fed funds futures has fallen from 2.93 in early November to 2.37 at present, implying no further tightening whatsoever.
Okay, the US President anyway saying the Fed doesn't have a feel of the market. I wonder if those comments will really come home. Anyhow, let's move on to the money market action now. Here are the views coming in. Bhaskar Panda of HDFC Bank says yesterday the US ISM data has bolstered hopes for a rate cut in the US in 2019. He says overnight risk assets were hit, and in India the USD INR market has shown that volatility won't go away in the new year if we go by the last few trading sessions. He is expecting the dollar INR pair to trade in a range of 69.85 to 70.15 for the day.
And Bhaskar, as far as the Indian benchmark bond yields are concerned, says there is a rally in yields fearing fiscal slippage. Today, he expects the 10-year benchmark bond yield to trade within the range of 7.4 to 7.5. This is one thing that's not working too much in favor of the mid caps. The cost of capital is coming down globally, but in India it's going up because of the fiscal slippage. So to that extent, the mid-cap rally will have to take time.